All right, welcome. Today, we're going to be talking about real estate tax hacks and mastering cost segregation. And we're going to be kind of giving you a good breakdown of who that's for, why it's powerful, and then break down some of the advantages and strategy around using it, but also like, what does it actually look like? What does a cost segregation do, and all the power behind it? So we're going to be digging into that. I'm excited to share this as it's part of a lot of the strategies that we help implement for clients. Helps take advantage of a cost segregation study. And so by being able to explain a little bit more into this piece of it and why you should be probably looking at it for yourself, and how to even educate a client on it. If you're a real estate professional, you're a real estate agent looking to learn more, not only for your personal sake, for your personal tax strategy, but educating a client on the benefits of this. If you have investor clients who are looking to take advantage of the full spectrum of real estate, this is a really big one to understand and know when to accurately say, hey, this is a good quality thing that you should be looking at. So let's go ahead and dive in. We're going to be talking first about what a cost segregation study is and what the differences are compared to just straight line depreciation. So let's kind of get this out of the way. If you're wondering what this is about, it's about depreciation. It's about using depreciation and the benefit of that for your tax purposes when you buy investment real estate. Straight line depreciation is what the IRS just gives you as a default. So for residential properties, that's 27 and a half years. For commercial properties, that's 39 years. And what the IRS says is, hey, you're going to take the value of the structure that you just bought minus the land, because we can't depreciate. Land doesn't depreciate, but the structure does.
And land improvements too as well, right?
Exactly. Yeah. Landscaping, there's all sorts of things, pavement.
Water retention.
Exactly. There's a lot of things that you can do to improve the land. But those are like man-made things, right? The land itself never actually depreciates. You're going to take the value of that structure and the land improvements that you have to go along with that, and you're going to split the cost up, or split the basis of that up over 39 years or 27 and a half years, right? And you're going to take a standard deduction. And so for most people, that's a really easy way to kind of make this click. Is it's basically standard deduction versus an itemized deduction, right? Instead of just taking the standard that the IRS gives me, I'm going to go ahead and choose to run a cost segregation study, and that's going to help me itemize the components of this structure, the components of my real property, and I'm going to front load the depreciation schedule. So some really cool things there.
Right, because it starts that kind of depreciation cycle at year one when you place it into service. But there are items within that structure, within that property, that break down at different rates, right? So if we have some certain things, light fixtures that may break down over the course of 5 years, then we start the depreciation on those light fixtures at year one, and we take depreciation on them for only the first 5 years. So all those components that are broken down into 5 or 7 or 15 years end up starting their schedule right at the first year. And so we're front loading all of that to the front end.
Right. Yeah, we don't need to depreciate a light bulb over 39 years.
Yeah.
So we know better. We know that the different components within our house have different lifespans.
Right.
They're not all the same. And so it's just being proactive in saying, hey, here's the itemized deductions that I'm looking to take on this in terms of depreciation against this asset. And it helps you on the tax side. Okay. So let's move in, because we're going to dive in a little bit further into what cost segregation is, but that's just the difference between straight line versus kind of this itemized idea of running a cost segregation study. Who is this for? Who is it not for? Let's dive into that. So who is this for? We're going to talk about 3 different classifications. And I encourage you to look back probably at our last couple videos, because we went really into depth in terms of active versus passive income, how to maximize a real estate strategy for this. So we're going to use some of that stuff that we've been talking about already and just build off that. So if you've been following along, you're probably going to be able to loop in a little bit easier than somebody who just jumps into this video. But let's start with the person who has an active income, who is qualifying as a real estate professional, and they have passive losses. Okay. So who is this for? Somebody who can take advantage of this is somebody who is a high income earner on the active side, right? They've got a job, they've got a business, they own a business, whatever that might be. Their spouse brings in a lot of income. They have a tax bill on the active side. and they're looking to go ahead and take the losses or the depreciation from their passive investment over here.
Hmm.
Because they qualify as a real estate professional, they're allowed to take those passive losses and deduct them against their active income. Okay. So that's person number one. Person number two, Matt, you want to hit that?
Yeah, person number two is the individual that has a high income and they want to use that property in kind of a different use. And so you've heard this called as the short term rental loophole. Not really a loophole; it's just a thing. What you're doing with that rental property is you're changing the function of that property into a hospitality business. You're changing that into an active business, and so the IRS says, "Hey, you qualify this whole business as a actual active business. You're actively involved in the day to day. You're dealing with guests as they stay. You're cleaning stuff up after in between guests, little repairs here and there. You're seeing to the day to day, and they're saying, hey, that active business is considered active income in this case. So income and losses from that business are then taken, and they can be taken against your active income then. So not just the income from the Airbnb that you have, but also the income from, let's say, the salary that you get, or the however you get paid as a doctor or a lawyer or whatever.
Yep. And the person number three that we're going to talk about here is somebody who lives their life on the passive side already. So a lot of our videos have been talking about how to jump the active passive line, or how to live, how to claim, passive loss or active losses against your active income. But what about the person who is either retired, or they might have enough passive investments coming in where they have a passive tax bill that they're trying to offset?
Yeah,
And
this could be a somebody who's investing heavily in real estate, but they're not materially participating in that business, right? It could be the person who's completely hands off with those investments. They'd pass that over to a rental property property manager, and they're just staying passive on that.
Yep. Yep. Somebody who has a passive role in a business, right? Maybe they have an
Right.
ownership stake in a business where they're not in an active role, they're just in a passive role. And they're looking at that business liquidating here in the next year or two, right? Or maybe it's this year. And they say, okay, I'm going to have this big taxable event here on the passive side. What do? I could buy some property. I could run a cost segregation study, use the losses from that property to offset this other passive income that's going to be coming in. Okay. So, three different types of people. Now, what do all three of these people have in common? Well, all three of these people have a tax problem, right? They all have a tax bill, right? So that in general, when we talk about somebody who can really utilize the benefits of a cost segregation study, it's somebody who has a tax bill to offset. And inversely, we're going to go ahead and talk about maybe somebody who this wouldn't be for. And it's for somebody who's not in a tax bracket that this would matter much, right? And it's not necessarily meaning that they don't make enough, but maybe they already have other strategies employed or other retirement accounts that are helping kind of lower that tax bracket and lower that taxable income. And they already have things employed and in place where adding another thing like this, like real estate or like a cost segregation study, isn't very advantageous.
Right. It could be your employer sponsored 401k or an IRA, HSA accounts, these things that are tax shelters for your money anyways, that would make it so the IRS doesn't view that income that you have as taxable income at that point. It lowers your taxable income, your adjusted gross income down anyway. So the person that's already employing some of these strategies doesn't really have a whole lot to offset necessarily.
Yep. Another person who this wouldn't be for would just be somebody who has a property value that just isn't very high.
Sure.
Right. And so there's a minimum threshold here that you would be looking at in terms of capitalizing on a cost segregation study. If you're looking at, let's just say, a $250,000 property, and $100,000 of that is land, right? So let's say $150,000 that you can depreciate. If you're running a cost seg study that might only get, let's just say, 15 to 20% of cost seg in year one, right? That's a very small amount to go ahead and be reducing your taxable income by. And so the more expensive the property, the more expensive that asset is, the better it is, because when you factor in everything else, like we take advantage of in real estate, like leverage, all these other things, makes a big difference when you start to kind of factor it in at the higher price points.
Right.
Yep. The third person would be somebody who's going to hold the property for a short period of time. And we'll get into this kind of as we explain the details of how a cost seg is broken up into the different timelines that they have, and how this is incentivized further with bonus depreciation currently right now. So this will make more sense as we get to that. But realistically, you need to be holding on to a property probably in our scenario, we say 4 to 6 years, 4 to 5 years to really kind of start to grasp most of the benefit. If you're holding on to a property for 1 year, you're missing out on a big portion of what that cost seg actually did for you.
Yeah.
And you want to you want to hold that property for enough time to be able to capture that benefit.
So year one will be significantly bigger than just the standard amount that you get on a normal depreciation schedule. But years 2, 3, 4 even are still bigger than what you would normally get. And so that would be the benefit of this. Really just kind of shortly hitting on if you do sell, just sell outright. This is deferred taxes. And so there's some recapture of the taxable portion of this that can happen unless you employ a different strategy. It's a 1031 exchange, or losses from another property that can offset kind of a gain that would happen as well. So there's other ways to get rid of a property if you have a short hold time. But for the most part, a lot of times, really looking at a longer hold time in general is something that we really want to encourage people to do. Eventually, we want to be able to use cash flow from that property to offset income.
Yep. Perfect. Let's go ahead and move into the details of cost segregation study, how that breaks down, and share a little bit more so that you have more information for yourself, but also if you're looking at explaining this a little bit to a client or explaining it to your spouse or explaining it to your kid, you might have a good space to be able to expand on this thought. So let's dive in. I'm going to go ahead and illustrate, Matt, as you kind of break us down into kind of the components of what a cost segregation study breaks your depreciation cycle into.
Right. So there are items within the structure that need to be depreciated at the full lifespan of the property, and so stuff like framing, some of the structural components may be the full 27 and a half years for a residential property or 39 years for a commercial property. Think of the shell of an industrial space that is concrete building structure. That sort of thing isn't going to break down in 5 years. And so the IRS says, all right, there's some things, there's a schedule that you can go for several of these items depending on their use. HVAC items are kind of a tricky one too. It's funny. I focus on those as my specialty. Depending on their use, if that's for comfort cooling, that might be having a different depreciation schedule than if that's for the sole use of just cooling off other equipment. So just the different uses are outlined, and then a CPA and an engineer would break down as they do this cost segregation study. They break down kind of each of those items, each of those item categories, and the timeline that they break down in.
Yep.
So they're kind of broken down. The three that we see are 5 years, 7 years, 15 years that some of these items fall down into. When we talk about bonus depreciation later, the rule is that you can take bonus depreciation on items that are below 20 years. But as we look at the example cost segregation studies we've seen, they're kind of broken down into 5, 7, 15 years. So what are some things that we see in the 5 year? This isn't something that's like all inclusive. We may share some wrong information. We're looking at an example of a cost seg study that was ran on a property for a client, but some things that are included in that. 5 years, you might see the wall outlets, I think is one of them. Security cameras.
Yep. We've got different finishes, like some baseboards, and this probably is dependent upon the material, right?
Yeah,
so different baseboards, different carpet, mirrors, soap dispensers, base cabinets, security cameras, locks, different hookups for microwave, refrigerator, different outlets, like you said, different types of outlets throughout the whole space.
Yep.
Life
fixtures, really.
Yep. A lot of that breaks down into the 5 year category. There wasn't really much for the 7 year, but the 15 year is where we got a lot of the bulk too of most people when they think about the value from a cost segregation study. It's all those site improvements.
Mm,
And so not every site improvement might fall into this category, but a lot of them did in this scenario. And so looking at those um, and how they can be benefited, that might be advantageous to be thinking proactively about. So
mm,
when we talk with clients who are looking to buy or manage Airbnb rentals, right? And you're looking at doing some upgrades to the property for amenities and what you can provide to the people who stay at your property. Um, Thinking through what might be advantageous in terms of depreciation schedule on a cost seg study is just another little factor to throw in there. So, you know, going in and building a pickleball court. We're here in Arizona, so those are big everywhere. Everywhere has them. Every Airbnb seems to want to have them. And so if you have a backyard pickleball court and you build that thing out, it's probably going to be on a 15-year schedule, all the components. And so that's going to be a massive, massive benefit to you
mm.
in terms of taking depreciation on that asset.
And we're
So
talking about just the normal depreciation schedule of that 15 years. I'm not sure where that one falls in particular, but let's
yeah,
say it's 15 years. Uh, that means that the total value of that portion of the land improvements can be depreciated over the course of 15 years. Where this gets real fun is when we talk about bonus depreciation.
yeah,
So,
yeah. Let's go right into bonus depreciation because that's when this really became supercharged.
mm,
Now, cost segregation studies on their own without bonus depreciation, they still help front load the depreciation schedule,
right.
right? So it just like Matt broke down earlier, it's still taking those 5, 7, and 15-year components and it's throwing them on a shorter lifespan, which obviously means every year you can take a higher percentage of what that cost value would be.
Mm.
With bonus depreciation, that's where things get really supercharged. And so, Matt, break that down.
Yeah.
What happened in 2017?
So 2017, bill got signed into law, the
Tax
Tax
Cuts and
Cuts and
Jobs Act.
Jobs Act.
Yep, yep.
Covered a lot of things, but one of the things that was covered was the idea of bonus depreciation in that. And it says basically the items within a structure that are that would depreciate in a 20 years or shorter lifetime can be taken as depreciation the year that that was placed into service. And so you put a property into service after this bill was enacted. They set the timeline for start date as September 27th, 2017, and all the way up until the end of 2022.
Yeah.
If any property was placed into service as a rental property in that timeline, then you could take all of these things that depreciate in a shorter time span than 20 years and take 100% of that depreciation year one.
Yeah. Now, if that's not like ringing an alarm bell inside your head of like, holy cow, what does that mean?
Hmm.
How do I? What's the true power of that? Right? When we look at different property types, that's where you get some serious game
Hmm.
on kind of taking advantage of that strategy, right? So while to Matt's point, while if you buy a big industrial complex, right, and most of the components within this big basically shell of a building are probably over 39 years, you look at a different property type, like let's just say an RV park, where most of the components are land improvements and other things that fall under that 20-year category.
Hmm.
You're looking at, sometimes in cases, we just spoke to a CPA here, cost seg specialist expert here on LinkedIn just this week, and he was saying, hey, you can see sometimes as high as above 80%
Hmm.
of the value, right, thrown into a cost seg. Now, if you bought one of those prior to the end of 2022, you're taking potentially 80% or more of the value of that asset, and you are getting that back 100% of that, boom, in year one, the moment that you bought it. So
Math on this. Let's say you put you purchase an RV park for 1.2 million. Let's say $200,000 of the value is the land. You have $1 million of depreciable asset there.
mhm,
If 80% of that $1 million, 80% of that property then is something that falls under the 20-year depreciation schedule. $800,000 of that could be depreciated year one, as assuming that it was placed into service end of 2017 through 2022.
Right.
$800,000.
Matt, how much did you put down on that? Maybe 30. Let's just say you put 30% down.
Yeah. We're a much lower number.
Right. Yeah, we'll do the quick math on the back of the napkin. No, but you're looking at not only offsetting your down payment that you put on, and probably a lot of the costs that you did in getting that property ready to be in service. But then you're looking at all the excess that you get to go ahead and deduct. And whether if you're a real estate professional, you're deducting that right against your active income from different businesses and your spouse's income, whatever that looks like.
Yep.
Or if you're just like, hey, that's way too much, right? I bought an RV park and I had this much. That's sitting there in a bucket for you to use in future years and to draw from in terms of lowering that taxable income.
Yeah.
So really, really cool stuff that you get while running a cost segregation. Now, as we expand on that, that was for years, right? 2017, September of 2017 to the end of 2022. Right. Now what's going down is this idea of bonus depreciation. So take all those items that are under that 20-year lifespan. If you were in that timeline, you got 100% of that stuff, 100% of the value of that in year one that you can use as a depreciation.
Yep.
Right.
That's phasing out.
Yep.
Yeah. So each year after 2022. So 2023, if a property was placed into service in 2023, that was dropped down to 80%. For 2024 this year, if you place a rental property into service this year, you can take 60% bonus depreciation. For 2025, it'll be 40%. 2026, it'll be 20%. And finally, in 2027, if you place a property into service, there is no bonus depreciation available. So it is sunsetting. It is phasing out. It's slowly. It's year after year. There's a little bit of urgency of getting some properties that would be placed into service earlier rather than later because you miss out on some of that bonus. There is some legislation in place right now. Passed the House, HR 7024, passed through the House, was passed on to the Senate, and they have it in their general calendar for talking about and voting on. If it passes the Senate, it'll be passed on to the president and could be signed into law. With that, we could see a return of 100% bonus depreciation. I think it was up through 2026 or 2027.
And then 27, it drops to 20%.
Yeah.
I believe. Yeah. So no idea, obviously, if that's going to get passed, right? But it was like you had stated, kind of a bipartisan pass right through. And now it's, you said in the Senate right now, right?
Yeah. Still needs to go through the Senate. And it's a long road. It may not pass in its current state. It may be pulled out of that anyways, but they're trying to see if we can get bonus depreciation back up for a little bit longer.
I think people like it. So hopefully we're in the works. Yeah. Hopefully we're in the works of that kind of coming back around and everybody being able to take advantage of it for a longer period of time.
That'd be nice.
But either way, right? Like we said, either way, with or without bonus depreciation, a cost segregation study is still a way to front load the depreciation cycle. And it's a good thing to be able to take advantage of in terms of just not doing the standard deduction, doing an itemized cost segregation study.
So what's the big deal? What's the big real power of this then?
Yeah. The big deal about a cost segregation is when you take the losses, right? When I take that excess depreciation up front, I take that loss, I'm lowering my tax liability. That is the big deal. Right.
I'm paying less taxes.
I'm paying less taxes that year.
Right.
And that's deferring it. But when I pay less taxes, what am I doing with that money? That's where this becomes a snowball effect. And that's where it really becomes powerful, is when I can take the money that I would have been paying in taxes and I can reinvest that
into a Tesla.
Yeah, sure. Or back into your business. Or in our case, we talk a lot about business owners bulletproofing themselves. That is what this series is for as well. Yep. Let's pull money from the business. Let's not stick it back into it. It's there to serve you, right? I'm going to pull money. I'm going to lower my taxable income and I'm going to reinvest that money. And we would love to see you buy more real estate with it. That's what we do.
Yeah.
Is taking that money that we save, boom, let's dump that. All right, let's continue to roll that and grow that on a further schedule.
And what you're doing with that, we talked a little bit, I think, last week or the week before about how that kind of compounds. The similar concept here is the person who has access to like a a 401k match with their employer.
Yep.
If I put in, let's say, 6% of my earnings into a 401k, and my employer is going to match 50% of that, that means that for every dollar I put in, I get a 50% return on that, without even taking into account what the market is doing. In this case, it's a little bit different, but basically, if you're in a high tax bracket, let's say you're in the 37% federal tax bracket, it's basically like Uncle Sam saying, hey, here's 37 cents back on each dollar that you put into this investment, and you can hold on to that for now.
Yep. Yeah, and when you reinvest that, yeah.
We talked again about leverage, leveraged asset, and how the returns on leverage are even greater. We turn around and take our tax savings and invest those tax savings. We can really snowball effect all of this. Next year, if I made $500,000 this year, and next year I'm going to make $500,000, I'm going to still have the same tax problem next year, and I'm also going to have the tax benefits from this year, and all of this can compound on itself.
Yeah, exactly. So again, to wrap this up, this idea of cost segregations, why they can be advantageous to you. To wrap this up, if you're a real estate professional or you're an agent watching this works really well for your own tax strategy, right? When you buy investment properties, you should be taking advantage of this to go ahead and offset active income if you qualify as a real estate professional. You should also learn more and know more about these for your investor clients as well, to maybe educate them on the use of it and when they should use them. If you have kind of more questions, feel free to DM us around that. That's kind of the best way to directly get in contact with us. We're real people. We don't have other people running our social medias for us. Get in contact with us and let us know kind of what you're looking at doing with a cost seg, or what you're looking at doing with your tax strategy when it comes to real estate. And that's what we specialize in. We specialize in breaking this down one-on-one with every client that we work with. And we build a specific strategy for you to take advantage of. So that's the really cool thing here. Let's wrap this up. I think it would be good. It would be great for us to have kind of a cost seg expert. There are plenty of them out there who center their businesses around this, CPAs and engineers who center their business around doing this for clients. And I'd love to kind of break one down in detail and get maybe more detail on kind of all of the little components that get broken out, and really even solidifying what asset class is best. Settle the argument there, bringing an expert on to talk about that more. So cool. Awesome. Well, we'll leave you there this week. Looking forward to hopping on next week and continuing to break down this Bulletproof Business Owner series.